What is up, guys? What is up? Welcome. Crypto Vud. Fix my microphone here. Yeah, we're good. What's going on, brother? We got the squad in the house. Bill, TJ, Compose, what's going on, brother? Brothers, what's going on, guys? Welcome. The day has come. We got the FOMC meeting today. Let's do this, guys. Let's do this. You guys excited? What are you guys thinking today? Let's start a poll immediately. Let's do this. What are you guys thinking? No cut? Or are we getting a cut? Let that poll run. Let's just jump right into this, guys. So welcome. Hope you guys are having a fantastic day today. It is 1:45 Eastern Standard Time. We're about 14 minutes to be exact before we get the decision as far as what the Feds are actually going to be doing, if we're going to be getting a rate cut today or not. And then after that, followed by, we will see Jerome Powell eventually come out and just basically talk. That's going to be a big thing. So obviously right now we know it's not written in stone, but we have a very high chance, right? 97.8% chance off of basically what they've gathered that most likely we're going to see some kind of a 25 basis point reduction for today. So we pretty much know that's going to happen. I think the only thing that would really throw a curveball is if we don't see a rate cut today. And I've said this before, and I'm going to say it again. Before anything pops off. Is the only reason why I would see today as where we got some crazy news that they weren't going to reduce interest rates would only be because of the government shutdown, right? And you're like, well, why is that? Well, that's because right now, technically, we did get the CPI report, right? We did get it. Came in great last week as far as inflation coming down, lower than forecasts. My thing is that the data that we're going to be getting in the next 3 weeks, well, we're not getting it, right? It gets collected the month prior, so we're not going to be getting it. So the only thing I could say, and I think this is just one off, like I really don't think there's like a 0.1% of this happening, but Jerome Powell using it for some kind of an excuse, saying that we don't know what next month's going to bring. We really don't know what's happening with inflation due to the numbers not being collected because of the government shutdown. Not going to harp on that. That's the only scenario where I see him, being able to basically just say we're going to put a pause for today. But I don't foresee that happening as of now. But we better hope it doesn't, right? Because the markets will probably short term take a shit if that does happen. So we'll see how that plays out. But as of now, 97.8%. Let me actually reload this to see if it's gone up any. Let's see here. 97.8. Yep. So 97% chance that we're going to see a rate cut. Right now, the markets aren't looking terrible. This is the daily. We're going to be flipping back over. When Jerome Powell does talk, we're going to go back into a very aggressive 5-minute chart so we can kind of see what's going on. But as of now, Bitcoin, we did see that normal pre-Fed meeting sell-off, right? It started pretty much 3 days ago where we did top out somewhere around 116,400. Remember, we're still reeling from 2 weeks ago, this massive liquidation event that we had. So the markets have slowly but surely been making higher lows as we've been moving. As far as Bitcoin, the S&P, NASDAQ, Dow Jones has all been making all-time highs the last couple of days. The stock market's been running. Gold's been down a considerable amount as well, below that $4,000 mark. So we're kind of just waiting to see, when's crypto going to get this money flowing in. We've seen some of it slightly come in, but I do think that we have some big moves coming regardless of today and the Feds and stuff like that. I really do think because of this, where we're at, this last three months of the year normally tends to be a big time for not only the crypto market, but the rest of the risk on assets, which everything else is running right now, right? So when is crypto going to start getting its ball together, and when are we going to start seeing this pickup, this buildup of money coming in? So I think that's really the big question right now. So we're going to be switching over from charts to charts. But we do have about 11 minutes until we get the data. And I want to cover some articles real quick while we're doing that. Let's see here. Jay said, made it early this time. What's going on? Hell yeah. Bill said, cut for sure. Job reports and layoffs were crazy. Yeah, and then remember yesterday, I think it was the news, Amazon is cutting like 15,000 jobs. And it's not due to the economy or anything like that. It's due to AI, right? AI has, I was talking to somebody the other day, and remember a few years ago when everybody was like, AI is going to take, a lot of people's jobs. And, you were like, you thought, you're like, hell yeah, probably in like 10 years from now, 15 years. Bro, 3 years later, it's now, right? Just look, UPS, 50,000 jobs. I mean, it's massive. And I think you have to look at it two different ways, right? First of all, NVIDIA, right? NVIDIA has been making all-time highs. Why is that? Because of AI, right? A lot of companies are doing really well because of AI, but the humans, right? The people, the workforce that are actually out there that are, that can be replaced by AI are being replaced by AI. It's two ways of looking at it. If you're the one that's been replaced by AI, it sucks. But if you're the person that owns the company and you're looking at it, you're like, holy shit, I can have AI basically do what 50,000 humans are doing, for a massive fraction of the price and probably be a little bit more efficient. Why wouldn't you do it, right? It sounds heartless, but at the same time, it's just the direction that we're heading. It's the direction that we're heading. It's the direction we've been heading for a while. So NVIDIA's been running. That's another thing too. A lot of people were talking about NVIDIA as well, saying, well, you know what? Bitcoin's actually down. This was as of yesterday. NVIDIA's up, Bitcoin's down. A lot of money's probably temporarily been moving over to NVIDIA right now. Gold, a lot of money's moving out of gold. Where is it probably going into? The S&P, the stock market, NVIDIA right now, it's all hot right now, right? But it's short term. I'm not saying NVIDIA is short term, but a lot of that money, that surge of money that's flowing in is usually short term. As soon as we start getting a massive rally in Bitcoin, what do you think a lot of these short term investors are going to be doing? They're going to be piling in on Bitcoin as well, helping us move the needle up, breaking all-time highs and stuff like that. So looking at the bubbles very briefly for today, you guys can see, I don't know why all the bubbles are all shifted over to the right today. But you guys can see, I mean, isn't that weird? Look at the bubbles on the left. There's like all this space and they're all like compact over here on the right. I've never seen that before. But you can see across the board, the markets right now, that pre-sell off before the Fed meetings, Trump's project's up 17%. I believe there was like a big announcement with something with Trump's coin. I didn't really even pay too much attention to it, but pumps up. Zcash has been absolutely ripping. You guys, I was today old when I found out that Zcash is actually a freaking fork of Bitcoin. Did you guys know that? Or am I the only freaking dumbass over here in the crypto space that didn't know that Zcash is a fork of Bitcoin? I was today old. I did not know that. Did not know that. But now I do, and I'm sure now you do as well. So we got 7 minutes until we get the information as far as rate cuts. I wanted to cover a couple articles real quick. So with ETFs and a lot of stuff going on, you're seeing a lot of these projects starting to move up. Solana has been doing really well. Can Solana handle 100 million Western Union users sending dollar tokens worldwide? I don't even need to read into this, and I'll answer it and say absolutely, right? If you are, familiar with DeFi, especially with Solana, I'm sure Solana does a lot more transactions daily than what anything that Western Union does, in my opinion. That's my opinion. I know Western Union is worldwide. Solana, during a meme coin frenzy, you can't sleep on Solana. They're doing really well as far as their ecosystem and being able to handle those transactions. Just reading into it, so Western Union will distribute a Solana-based stablecoin to its 100 million plus customers starting in the first half of 2026. This is big. Pairing Anchorage Digital Bank, federally regulated insurance with a globally on and off ramp network that converts crypto wallet balances to local cash. Holy shit, this is big. I didn't even realize this. So announced on the 28th, which was yesterday, this model changes the neutral infrastructure strategies deployed by Visa and Stripe. The US dollar payment token represents a test of whether vertical integration can bring blockchain remittance to mass adoption, where crypto native protocols have struggled to gain retail traction. Solana processes USDC transfers at sub-cent costs and settles in seconds, yet most cross-border senders will route payments through traditional money transfer operators or correspondence banking networks. And you know what's crazy? Khalil, what's going on, brother? What's crazy is I've talked about this before, right? We've talked about this before about I'm actually blown back that Western Union is getting in before they get canceled, right? And I say this, if you guys are just joining, welcome. We're going to, FOMC meeting, we already know everything's going to be starting off soon. We're getting information in about 4 minutes. But with this right here, I was talking about this with a while back. Western Union, if you guys have people that live across the world, right? We have, I'm sure a lot of people have families that live, or family members that live in other countries. A lot of people, especially people that move to America, they start making money in America and then they send it worldwide, right? Well, they use Western Union. Western Union, you have to drive up to somewhere, wherever they have it, gas stations or like your local, like those cash, those scammy cash places. And, you have to pay to do it. And it takes, I don't know if it's instantly, but it takes some time for it to get over there, right? And then someone else has to be over there and they have to be at another place. It's the same equivalency and, and receive it. The company receives it and then they, blah, 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 right? It's a pain in the ass. But the fact that they know in the next probably 10 years from now, most people, if not all, are not going to be doing this anymore because they can easily download a Solana wallet, right? And start sending worldwide currency, Solana, USDC, whatever the case is, worldwide instantly for fractions of the price. And it looks like Western Union is actually teaming up. Instead of them getting exited out of the equation, they're teaming up and they're going to be encouraging their users, their millions of users, to actually start using this technology, which is awesome. And they're going to start using Solana, which I'm sure a lot of people that start to do this will maybe start looking in and say, hey, what is this crypto stuff? What is this stuff? And maybe this could bring in a lot of money into Solana particularly, but into the crypto space as well. So just another way that crypto is innovating the world. Colosso, let's make some money. Let's make some money, bro. Let's do it, bro. Let's do it. Mask is pumping. How's DeFi doing right now? Let's see here. Who's SSI? Who's always in SSI? One of the members. Solana stock index up 30% today. Trump's official coin, whatever, is up 20%. Worthless up 15%. Mask is up 13%. Jay, I was like, it's somebody in here. I know it. Mask is up 13%. Bro, they've been doing pretty good. You know what's crazy, Jay, is that like it runs and then it like, look, you can see, I got to update the fib retracement. Let's see here. It actually, this looks good. I was going to say, I always feel like, damn, composed. 16 months. What was your name before this? I asked you this before. You changed your name. What was it before? I know it was something else. I know you just changed your name. I feel like you did. But hell yeah, bro. Appreciate you being a member for 16 flipping months, bro. 16 months. That's crazy. YouTube changed it. What was it before? It was Jay. So you're the other Jay, right? No, we have TJ. We have Jay Gamble. And Jay. We had 3 J's on here. Well, regardless, bro, I appreciate you. I appreciate the support, bro. Maybe 4. Hola, what's going on, brother? with the old school no FUD emblem, bro. Appreciate that. Yeah, it's throwing me off because I'm like composed. Obviously I see your picture. I'm like, all right, what's going on here? I know who this is, but the name's just not ringing a bell. So real quick, J SSI. Look at this spot right here. We called this before because obviously this was a spot that we've talked about before that was kind of like support. You guys, or you can see obviously with the big drawdown, you guys have finally made your way up towards this 1674 area, but it looks like it's going to be a spot for some big resistance as of now. But I mean, it looks good, bro. The project looks good. I was honestly worried. 183% from that bottom right there, bro. I hope you ate some of that bottom right there. 2 o'clock. 2 o'clock, boys and girls. Let's see here. Did we get some? All right. Feds just reduced. They reduced the rates. All right. You guys can see, I'm like, wait. This doesn't look good. So Feds just announced hot off the press that we got a 25 basis point reduction in interest rates. Hot off the press, going from 4.25 down to 4% as of now. So you can see, let's see if the markets are going to start moving right now off of this. Now, I do anticipate that a lot of this was already priced in, obviously, because we already knew this was going to be coming, so I would expect volatility because the big thing that we're waiting for is going to be Jerome Powell. What is he going to say? Is he coming out? Is he going to be dovish again, or are we going to be, is he going to start, like I said, giving out some implications that next month, because of the government shutdown, that we're not going to be reducing rates just because of that? That's what I think the big thing is, and that's going to probably be the big question. The government shutdown, obviously, with the feds not being able to gather information as far as the CPI report for next month, are we still on track for that reduction that we're supposed to see in December? So we just got that quarter basis point as of now. Oh, it's Jasmine. What's going on, bro? Everybody's freaking changed their name. What's going on? Is YouTube over there regulating on you guys? Like, I guess I'm going to have to change my name too, right? I have to change my name. Yeah, but Jay, nice little move. If you caught that bottom right there, bro, definitely a nice little rebound. H-bar, let's pull it up. Yeah, if you guys have any projects, we got 20 minutes. So if you guys want to pull anything up, let me know. Thought I had a chart. I guess I don't. I haven't looked at H-bar in freaking so long. I know they're doing really well with the whole ETF. Did H-bar get approved for the ETF? Bro, that's crazy. H-bar dropped down to 8 cents. Nice 152% rebound, 3x right there on H-bar. So it looks good. So a couple things with H-bar that I'll say. Obviously, I said this a few days ago for pretty much all the projects, right? We had this nice little W pattern that formed on like 90% of the projects. You can see, obviously, that W played out really well. Nice move towards the upside. It looks like we're hitting our head at the 0.5. Yep, the 0.5, which is around 21 cents as of now, is probably going to be your spot for some resistance as of now, right? You can see it was support, even though we would drop below. It kind of did hang around that 21 cent mark before it did drop down. So big spot for some resistance for now. I would probably anticipate that this needs to come up and probably retest it a few times before you're going to break above that 22 cent mark right there. So, but I mean, looks great. Obviously, the last like 6 days, this is on the daily. You've had nothing but beautiful, beautiful green candles heading towards the upside. So, and there's been a lot of good news on HBAR as of late. So, yeah, their ETF went live yesterday. There you go. I didn't realize we talked about the ETFs for the last year. I didn't freaking even. I'm over here like didn't even realize ETFs went live yesterday. I had to find out off of other YouTubers. I'm like, oh shit, ETFs went live yesterday. Completely missed it. If you guys are just joining, welcome, welcome, welcome. I see we got a few people just joining. Real quick, we did just get the news that the Feds reduced the rates 25 basis points. So we did get a nice little reduction in interest rates. So far in the last basically 2 meetings, FOMC meetings, we've gone down 0.5, half or 50 basis point to make it easy as of now. The markets, you can see technically not really feeling it. Not really feeling the quarter basis point. We kind of saw this last meeting, if you guys remember. We saw where that day, the day before, it was good, almost like what I said a little while ago, almost like a buy the rumors, tell the news event. But I think as the next few days go on, and really I think if we can ensure that we're going to get a Fed rate cut next meeting, all this is going to start really kicking in, right? Because right now you have to remember, the Feds are throwing crumbs out right now, right? They're giving us these quarter basis points. It's very small. The market wants to see an aggressive Fed. They want to see those 50, 75 basis point reductions. Right now we're getting these little 25, very conservative, reductions from the Feds, almost like they're forced to do it, right? We know Jerome Powell does not want to reduce rates for whatever reason. He just does not want to reduce rates. So what I'm getting to, and I've said this plenty of times in the last few weeks, is even if they continue to keep giving us these quarters, they're going to start adding up, right? They're going to start adding up, and in no time we will be down, 100 basis points from when we started. That's when you're really going to see these risk on assets really start benefiting off of this, because you're going to see a lot more money flowing into the not necessarily the economy, but yes, into the economy as well. Because remember, these are the Fed rates. People can take loans out for cheaper now, right? Companies can take loans out, take money out, can use money, can borrow money from the Feds at a lot cheaper rate. These quarters, they're not really doing much now, but in the next few months, as it adds up, next few meetings, really, it'll add up. And now you're talking about, before borrowing at 6%, now you're borrowing at 4.5%. I'm talking about 6%. This was last year or whatever the case is, but now you're borrowing at 3.5%. It's a big deal, right? That's a big deal. You just cut your interest in half essentially in the last year. It'll incentivize and have a lot more money flowing around, which a lot of money will come into riskier assets, stocks, crypto, and stuff like that. That's why at the end of the day, when Fed start to reduce rates, it technically is bullish for the stock market and risk on assets. So Bill said my HBAR bag got decimated from the liquidation event on the 10th. Well, I mean, but you didn't sell, right? You just was looking pretty bad when it was down, is what I'm imagining. I mean, everybody's portfolios at that time. I didn't even want to look at my portfolio at that time. Did not even want to look at it at that time. Tuan, what's going on, bro? What's going on, brother? What's crazy is right now, we remember, we did the members meeting, what was it, like 2 days ago, and we were back into neutral. We were looking like we were going to start moving, closer towards greed and stuff like that, and you can see we actually ticked back down into fear. Isn't that crazy? I don't know if it's because of the FOMC meeting. We're technically still in fear in the markets, but it's a crazy time in the markets. I'm telling you, I'm watching some of these old school people that have been in crypto for 10 plus years, have been in multiple bull cycles, and they're like, bro, they're scratching their head like, even them, they're like, bro, this shit's like a crazy cycle. This This has to be probably the most difficult cycle that we've gone through. The last few cycles have been pretty spot on as far as 4 years. This is what happens. This happens next. This cycle that we've been in has been so freaking like just, it's been out there as far as just, like with ETFs, Bitcoin making highs before ETFs, or I'm sorry, before the halving, excuse me, because of the ETFs. Just a lot of just different things with Trump getting into office and just it's been just a crazy, crazy time in the crypto space as of late. So, okay, you didn't sell. Okay, yeah. So, yeah, I mean, your portfolio was down like crazy. I bet, bro. What's crazy right now is looking at a lot of the projects like that we have on our list as of now are all in the green, right? You have Jasmy actually up 4.5%, Bunks up 3.5%, Myro 3.5%, Fetch 3%, ICP 1.5%, XRP 1.7%, Arbitrum 2.5%, Solana's up at around 1.3%, which technically, I mean, I think it was at 200 yesterday, so it's technically, I don't know, it's not above that $200 level as of now, and Ethereum below the 4,000 right there at 3,991. Again, we're seeing a lot of this because of that Jerome Powell kind of FOMC meeting sell-off as of now. Let's go over real quick. Let's refresh this because we already got the news, right? We already got the news that he was reducing rates. December, as of now, have they even updated this? I don't even think they updated this yet. 4%. Why is October's percent went down? Hold on here. I'm like confused here. Actual was 4, previous was 4 point. Yeah, they went down 0.25%. I'm wondering if TradingView made like some kind of a mistake or something. Because now I'm looking at October, which should already pass. It's saying 92%. I don't know. We'll have to figure that out here. I am looking. Jerome Powell is not on stage yet, guys. He is not on stage. He should be coming out in about 16 minutes from now. So, another bullish article that I did see while we're just killing some time until Powell comes out is the EU Bitcoin race starting. So France targets 420,000 Bitcoin as Germany weighs reserves. I think it's so funny when you hear that Germany is looking to add to its reserves when, what was it, last year they sold $2.5 or $3.5 billion worth of Bitcoin for like half the price that we're at right now. You can't even make this up. Let's see here. So for decades, Europe's wealth was measured in gold and bonds. Now, two of the largest economies are preparing to add something new to their strategic vaults. This week, news emerged that political leaders in Germany and France have introduced proposals to establish a national Bitcoin reserve in a move that could refine the architect of state reserves. So France's initiative came first with a remarkable detail. On the 28th of October, which was yesterday, President of the Union de la don't crucify me, Dorate Republique outlined an ambitious plan. Someone from France is watching this like, stupid American. Outlined an ambitious plan for the country to accumulate up to 420,000 Bitcoin over 7 to 8 years, roughly 2% of Bitcoin's fixed supply. If they were to really acquire 420,000 Bitcoin, as it stands right now, that's almost what Michael Saylor, it's a little bit less than what Michael Saylor owns right now. Think about that. That's a massive amount. 420,000 Bitcoin. That's a massive amount. A day later, Germany's, forgive me on this one too, Alternative für Deutschland reported reportedly introduced a motion suggests that Berlin explore a national Bitcoin strategy as a hedge against inflation and geopolitical instability. Together, these initiatives signal something unprecedented and a start of a European Bitcoin reserve race. This could reshape the continent's monetary and identity and challenge the dominance of gold in national asset allocations. And it's funny they bring that up because gold, we've been talking about this, right? We were talking about this while gold was rallying. I said two things. I said when gold broke over 4, especially 42, I was like, this would be a good spot to start shorting gold, right? It obviously went up a little bit higher, up to about 43.80. But you can see, came up there. It actually challenged that area a few times before breaking below. Now, the reason why gold was running like this was because, at the time, which was just a few weeks ago, we had the tariff scare again for the 17th time with China. A lot of instability, a lot of stuff going on, with the economy and with tweets from Trump and this and that. A lot of people were like, you know what, I'm just going to hedge into what's always been safe, right? And that's technically gold. So you saw gold surging and people FOMOing in, on gold. But since then, it topped. Do I think that it could possibly make its way back up? We could. I think a good scenario for us would be gold actually coming up and actually making a double top before it drops, right? Something like that. And that's why I haven't ruled out, and we've been talking about this on the members only stream, that gold easily can come right back up and retest this 43, 44 area before getting rejected. So I'm not saying that's necessarily what's going to happen, but it could. It very much could. So real quick, just checking the poll real quick. Looks like we have, 21 votes. Looks like 81% saying there's going to be there was a cut, right? There already was a cut. 81% calling for the cut, 19% saying there was going to be no cut today. I ended the poll. So I'm just like a little confused because we got the cut per trading view, but on the Fed over here, it keeps dropping. I don't know. I'm confused. And it says current target rates at 4.25. They haven't updated it yet. I don't know. A little behind on that one, but we'll see. But old Pally is going to be coming out in about 12 minutes, guys. 12 minutes. What do you guys have for plays while we're killing time? What's the plays right now for DeFi? Let's go over to Twitter. Let's see. Look at this. Oh, this was 2 hours ago. Just in $400 million in crypto long positions liquidated. We can go and look. Hold on here. Yeah, it looks like it just Bitcoin alone, $114 million in liquidations. On Ethereum, 121. Damn. For longs. That's crazy. How do people not know that most likely we're going to see that that we're most likely going to see a freaking the good old FOMC meeting sell off right before the meeting goes down. All right, so I was just confirming. Okay, so they did. They cut the rates by 25 basis points. Okay, we got the right information. The Fed announced that it will halt balance sheet reductions on December the 1st. Quantitative tightening is finally ending. We talked about that actually a few weeks ago when Jerome spoke about that. Looks like a couple other people that were on the Feds that are under Jerome Powell, we're really pushing for a 50 basis point cut. See, it says Justin Fed's lower rate by 25 basis points, so it should be 3.75 to 4. But on here, it's still saying from 4 to 4.25. That's why I was like a little confused. I don't know if the CME group hasn't updated their information yet for whatever reason. So, whatever. Well, let's see here. Still no Jerome Powell on stage yet, guys. We have about 9 minutes. About 9 minutes until Jerome Powell comes out. What else do we have? Flip, what's going on, bro? Did you go for your jog? It's got to be cold up there, Flip, right? Because it's down in Florida tonight. Guys, listen. Off topic, but tonight it's going to be in the 50s down here in Tampa. It's going to be in the 50s in Tampa tonight, guys. We're ready. It's got to be cold, bro. That cold front flew through. So right here, if you guys are like, what the hell are we looking at? We're looking at a liquidity map, right? Where a lot of liquidity is piled up. And you can see, as of now, we do have some liquidity around 110,800, right? We do have it, but it looks like we have a lot of liquidity towards the top up here. We have a lot of liquidity. Let's see here. We have a lot of liquidity at 113. Almost 113 even 113.3, and then it looks like we have a lot around 114,000 for liquidity. The reason why this is important, because a lot of times Bitcoin or whatever you're looking at will usually tend to move to wherever there's liquidity, right? You can see there's probably it looks like there's a lot more liquidity towards the upside as of right now, so I'm sure there's a lot of people hedging their bets, opening up their positions as far as their longs, even though we did just see that a lot of longs got flushed out because they're opening them up too early. As of now. You have Jerome Powell about to talk. Whenever there's uncertainty in the market, you know it's going to be volatility, right? There's going to be volatilities. There's going to be volatility, period, until this guy comes out and says what he needs to say. So, Bitcoin right now sitting at around 111,300. Looks like we do have some good support right now, somewhere around that 110,900, where we pretty much came and bounced off of so far as of now. So we'll see how he comes out, how he talks. I mean, this is really what it's all about. The way he delivers himself, and really whenever the reporters are asking him questions, I'm telling you, it's going to be focused on the government shutdown and are we going to get, what are the feds doing for next month, given that they're going to have no CPI report to work off of. I think that's going to be the biggest thing, and that might be why the markets are a little unsure as of right now, because we just got that quarter basis point like we discussed about 20 minutes ago. So Flip said, when's a 0.5 incoming? Because we already got the quarter. We already announced. It was 25 basis point reduction. You got more information? Are they dropping it another 50? You imagine that if they dropped another 50 on us on the same day? Let me get everything set up because I know Pally's about to be coming out. Let's see here. If you guys are wondering, I'm looking at another screen real quick as we wait. Let me actually see if I can put this on, so you guys know what I'm looking at here. That is what we're waiting for. 2:30 in about 5 minutes, guys. 5 minutes. So I'm gonna drop that screen and we'll bring it right back up whenever I see him get off stage. As of now, it looks like we're getting even the stock market right now. Stock market, S&P made all-time highs today at around 69.20, and it's even cooling off a little bit. Gold today actually is up slightly, about 0.7%, with just the uncertainty in the market right now. But I anticipate that if Jerome Powell comes out and he comes out and he's just basically saying it's time, like we just discussed. They already announced a few weeks ago, but they just confirmed 20 minutes ago the quantitative tightening as far as with the Feds is over by December the 1st. This is very bullish, right? I think they've gotten to a point, Jerome Powell has gotten to a point where, listen, inflation, we got the CPI report. It's not at 2% their target, but we're at 2.7%. We're so close. Coming from 9%, we are so close. It's time. I'm not saying start reducing interest rates by hundreds of basis points at one given time, but it's time. It's time for us to start moving the rates down. It's time for us to start opening up that liquidity to get into the economy. So 3 minutes, guys. 3 minutes. Guess we're doing a new poll. What do you guys think? You guys think that Jerome Powell is going to be dovish, or do you guys think he's going to be hawkish? If you're wondering what's the difference, dovish meaning Jerome Powell comes out and he's indicating yes, the Feds are going to be reducing rates, kind of with that kind of tone. Hawkish meaning we don't know, kind of doing that same what he's been doing for last year. I don't know if we're going to be reducing rates. We need information. What were the things we used to always say? He said inflation. What would he say? He said uncertainty, inflation. I forget. He would say it like over and over. Just every freaking month, it would be the same speech that Jerome Powell would give to us. Two minutes, guys. See or red, except for Trump. It's crazy. Willie Woo says the business cycle is on the brink of tipping over, and everything bubble could pop. It's funny, and we're not going to talk about this right now, but we've been talking about this on our members only stream, right? That there is a bear market that is going to be coming soon, right? I do believe 2026 at some point is going to be the beginning of a bear market. There's no way around it. We're way overdue. That's why our main goal on our member stream is really just trying to map out that top, getting as close as possible to the top of the market, and getting out so we can take advantage of the bear market. Because believe it or not, you think all the money is made during the bull market. It starts in the bear market. Getting in those positions when it is, rough out there, Same thing with crypto. I always keep an eye out because I actually, believe it or not, have more money in stocks and the S&P than I do in crypto technically, So S&P making all-time highs, I'm just keeping an eye on it because at some point soon I am going to be taking out everything I'm going to have literally just go straight to cash, whether I catch the top or I get close to it or whatever the case is. I don't care. We have 1 minute, guys. 1 minute, guys. Looks like right now 67% saying he's going to be dovish. I agree. I agree that we're probably going to see a dovish Jerome, Mr. Pally. But who knows? So right here, real quick before anything starts, we have the 5 minute chart. I'm actually going to go to the 1 minute. I like to have a little bit more dramatic, charts. So while he's talking, you're going to see the charts going up, fluctuating a lot. It's just, we're on the 1 minute. All right. This is going to be for Bitcoin. I'll switch over to Ethereum. And if anything else that if you guys want to look at while he is talking, just put it in the chat. I'm not going to be talking while Jerome's talking. So I'll be in the chat. I'll be in the chat if you need me. Just waiting here to see when he comes out. All right, he's out. Let's do this. He's out, guys. Or the stage is set. There he is. Second most powerful guy.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but
this is Buick now.
Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 3.75% to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments.
Look at that red
We will continue to
candle.
determine the appropriate stance of monetary policy
Oh my.
based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided
Stop
risks.
talking, Jerome.
In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet.
Did he say that, Flip?
The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country.
Damn it, he did.
Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
I told you that he was going to do that because the government shut down. Here we go with the questions. Get ready, guys.
Nick Timmeros of the Wall Street Journal. Chair Powell,
He's got
are you
nice hair.
uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board.
Stop asking him
We
that
had,
question.
just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee.
I'm covering the red
As I
candle
mentioned,
right now.
there were strongly differing views today.
You guys don't want to
And,
see what I see
The
right
takeaway
now.
from that is that we haven't made a decision about December, and we're going to be looking at the data that we have, how that affects the outlook and the balance of risks, and I'll just say that.
You and some of your colleagues have framed last month, and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and it suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, others people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire.
I'm Claire Jones, Financial Times. Thank you for taking this question.
Love the scarf.
We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household
Get
wealth
ready for
through
the Trump
rises
tweet.
in
Get
stock
ready.
prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when participants go out and talk, they're very disparate views. And they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks.
Let me know what I missed.
And that's what leads me to say that that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice. And so there's not a lot of benefit to be, to be holding on to get the last few dollars because, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you, Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state-level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings, and we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah.
Seriously.
So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity, and we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things, but I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's, the meeting's, I guess, 6 weeks away. We just don't know what we're going to get.
Punk, I'll explain it to you in a second.
If there is a very high level of uncertainty, then, that could be an argument in favor of caution about moving. But we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's
labor market
it's
stable?
not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what. In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. and because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long, but at a certain point, you'll want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding Treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Even gold's dropping.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that.
Why wouldn't you be reducing?
The thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
111, guys.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that?
Look at the crypto bubble.
And especially when we're seeing potentially labor supply challenges.
Sorry, say that first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is is a big part of that. But
yeah,
also just,
she's
we think
Becky.
policy is still modestly restrictive
Sure.
in my telling. So that's
was
the
just
kind of thing
thinking
that should
that,
lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because, the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press.
Make sure you
So
guys hit
there's a
that
big
mic.
investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
The spirit of Kentucky.
I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys of the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This was going to be an issue.
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down.
It's obvious, but
that could or could not. I don't know how that's going to play into things.
the Feds
we may
will
get
not have any
the
data for
may
next
come
month.
back,
Just
but there's a
remember that.
possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's
Give this
certainly a
guy
possibility
any
that you would
reason to
say
pause, and he's going to pause.
we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stresses starting to appear in the the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully, and yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are, if you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern?
Did I not
well,
call
the perspectives of people on the committee
I told you
that
he was gonna do
we've
this
now
shit.
moved 150 basis points, and that we're down into you're into that range between 3 and 4, where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of Fomc participants, and now I'm telling you that's what you can expect that in the minutes. And I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are two things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's two things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand? And and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
You know, we don't look at any one asset price and say, hey, that's wrong. You know, it's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, you know, banks are well capitalized, while some households are clearly under stress. In the aggregate, you know, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. You know, we don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, you know, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not you know, about 25 basis points here or there. You know, we use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here to, by lowering rates
I'm down with
at the
not
margin,
paying
that will
taxes
support
anymore,
demand, and that will support more hiring.
Where do I
And that's
sign
why
up?
we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, you know, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, you know, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But you know, because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, you know, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these were ideas rather than companies, and you know so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and you know it looks like they have business models and profits and that kind of thing. So it's really a different thing. You know, the investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, you know, is much bigger than that and has been growing and has defied a lot of, you know, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, maybe growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information and you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come up, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we do get.
Amazon just announced
we look at
15,000 layoffs yesterday.
Unemployment insurance claims, initial claims, are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular section of the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment, and this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both, so we have to balance the two. And so it's a challenging thing, and
Build a website you love.
Which we should do it, and that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question. Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit
They're talking about
institutions having
with auto
significant losses, and some of those losses are now
people
showing
that
up on
bought
the books
cars
of banks.
or have
we're looking at it
$1,500,
carefully.
car
We're paying
payments.
close attention.
not paying their payments.
I
like
don't
$1,500
see
payments.
at this
Who the hell
point
did that?
a broader
Why?
credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market it would affect spending if the stock market went down, but it wouldn't drop. It wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
Is that it? Sheesh. Well, we survived that one. Let me just get 10 minutes of your time. Let's go over everything real quick. Let me get this the hell off our screen. It's nonsense here. Whew. All right. Let's talk about this. All right, guys. So listen, real quick. Craziness. So basically, Jerome, he indicated exactly what I said at the beginning before we even started watching him talk, right? Pretty much, and this isn't to be expected with the government shutdown. The CPI report, right? Remember, we got the CPI report last month. The PCE, all these numbers, they're basically generated usually a month before they're released, right? So you have this month, the government shut down, right? The government's been shut down for some weeks now. Next month, they're basically looking at, they're going to be walking in to the month blind, where there's going to be no data that they can see. We know that the data is not going to go crazy, like inflation is not going to just jump from 2.7% up to 7% or anything like that. But I said, you give Jerome Powell anything, you give him just anything for him to hit a pause, he's going to do it, right? And the reason why is because, and the reason why I say this is because he should have reduced rates a long time ago, and he didn't, right? He kept saying the same thing over and over. Once tariffs came in, that was the new thing. Before that, it was whatever the case was, unemployment, which, that's a whole other thing that we'll get into. He said at the beginning he wanted 4% unemployment. We hit 4%. Now he was like, oh, we need 4.2. We hit 4.2. Now he's looking for higher unemployment. The point of what I'm getting to is he has been very reluctant on reducing rates. So if you give him anything to run off of not reducing rates, he's going to do it. And it's not that he wants to see the economy fail or he wants to see the markets crash or anything like that. He's just trying to protect his own ass. When he leaves here, he wants to make sure that he's not, he didn't leave with the note on that he reduced interest rates too early or anything like that. That's like, when you're in his position, that's like the number one thing, So the point of what I'm getting to is, with the government shutdown, that was like the number one thing. Unemployment, we all know, it's not like terrible, but it's gotten to the point where they wanted it to get to, right? Inflation. We got a great CPI report last month. Hence, that's why they reduced interest rates a quarter basis point, which to me is just they're throwing out crumbs. They're throwing out crumbs when they should be reducing interest rates, to me, a little bit more aggressively. I think that's going to come down the road. But the point of what I'm getting to is next month, we don't know if we're even going to see a reduction in interest rates. Let's actually look and see. Now that we have Jerome Powell, he spoke, let's see what December is bringing in. Look at this. Look at this, guys. This has literally shifted. So before the meeting, we were at around 90% that we were going to see some kind of a reduction. Now it is shifted to 63%, calling for a 25 basis point, and 35% of the 33% of the of basically 33% calling for some kind of a pause, and 3%. That's why I'm stuttering over here, because I'm looking. I'm like, really? 3% are saying that they're going to increase interest rates, which that's not going to happen. But that should show you where the markets are at right now. It's just all over the place. The markets, going before this, the markets were pricing in three interest rate reductions this month. Now, we got the 2, but December seems to be in limbo now because of this government shutdown. So hopefully we can get this government, turned back on, but still, it doesn't mean anything, because remember, the CPI report and all the numbers that we get to see, that we saw last week, that was all generated last month. Meaning any data that they're going to be running off of next month, or in December, to reduce rates, we're not going to have. We're not going to have it. So it stinks. It sucks. Like I said, you give this guy anything to just basically be hawkish, and he is going to do it. He's going to do it. That's why, unfortunately, and again, not political whatsoever, but that's why there's, Trump right now. I'm just can only imagine if I get on Twitter, I'm sure we're going to get a Trump tweet here soon with him basically saying, Jerome Powell, Mr. Too Late, whatever the case is. It's just, yeah. We got the 25 basis point, but at the end of the day, we're left with this kind of like, uncertainty in the market. And that's what markets hate. What's going on, Ricky, is the uncertainty, right? Now, we're most likely, the way it looks, I'm not going to say most likely, but it's probably, I would imagine that this right here is probably going to go 50-50 if we're going to see some kind of a reduction. Remember, we just came off a 90%. It's going to go down to probably 50-50. Are we going to see some kind of a rate cut next month? Who knows? Do I think the Feds have enough ammunition to not reduce rates? Absolutely not. I think that they are just looking for anything. They're grasping at straws, right? And it's really Jerome, at anything to not reduce rates. For whatever reason this guy is fixated on, he does not want to just reduce rates. So it is what it is. I think the main thing that we need to focus on is that we'll probably brush this off in the next, couple days. We'll move on. The markets will probably just naturally do whatever they're going to do, whether whether we're going to be moving up or down. I would anticipate that we're probably going to be moving down. I don't see any reason why. We have Trump tomorrow. He's going to be talking to China about tariffs and stuff like that. Stuff like that. We have a lot of bullish stuff in front of us. So I'm just looking at the markets right now, because also the markets are about to close, the stock market. So we're on top of Jerome Powell dropping the mic on us right now. We're also getting, the markets are about to be closing as well. So it's kind of the same thing we left off last FOMC meeting. It's just like, reduce interest rates, but at the end of the day, we're still seeing a sell-off because it's just like we can't get any bullishness from Jerome whatsoever. And that's why they want to replace him. That right there is why they want to replace him. So it is what it is. Hopefully we'll blow past all this. In the next few days we'll get back up and running. But for tonight, I would probably tonight, at least until the next 25 minutes when the market's closing, I would just expect what we're seeing. Just because we were left with uncertainty at the end of the day. We're left with uncertainty. We don't know next month if we're going to see that reduction. We're not going to have the data. I'm quoting Jerome, so expect if the markets are going to come down, gold's down actually right now. Gold's actually down just like the rest of the market. The S&P's down. Obviously, Bitcoin's down 2%. Ethereum down to 39.14, right? So, we still see green across the board. But, we'll see how this plays out. I'm not expecting some kind of a major dump or anything like that. I'm just expecting, just us. It's probably going to take, a couple of days for us to kind of blow this off, forget about it for the time being, and let the markets just naturally do what they do. So, with that, guys, that's pretty much it, guys. I wish that we would have been, ending this off of such a great note. Like, yes, Bitcoin's running up to all-time highs. Don't end the stream. But we're not doing that, right? So it is what it is. It's October, guys. Don't forget, I do want to end it off. Do not forget, right? This is October, right? Do not forget that we normally are in. This is a solid month. We're only down about 1-2% right now. Things can change. I know we only have 2-3 days left, but just don't forget what these last 3 months normally turn out to be. Not just green months, but big months for the market. So I still am anticipating that whatsoever, regardless of what Jerome Powell has in front of us. I'm still anticipating big movements towards the upside, guys. So just keep your heads up. With that being said, thank you guys so much for being here. I do appreciate you guys being here today. If you're watching this after the fact, hit that like, hit the subscribe if you guys are new. We'll be back tomorrow. Members, I'll see you guys soon. All right, guys? All right. Thank you.